Nvidia just dropped 4%, Meta collapsed, Palantir fell 8%, and that's over 1 trillion wiped from tech valuations in a single week. And everyone asking the same question: is the AI bubble finally bursting? Well, I'm here to give you the real answer. And spoiler alert, it's more complicated than the headlines suggest. But here's what you need to know. If you have money in tech stocks, stick around, because we're breaking down exactly what happened and what it means for your portfolio, and most importantly, whether you should be selling everything or buying the dip. Stay to the end of the video. Hey everyone, welcome back to StockScope Live. Last week was brutal for tech stocks. I'm talking about one of the worst weeks we've seen in months. The Nasdaq composite, which is the weighted heavily toward tech and AI companies, fell 3% in a single week. That's the worst weekly performance we've seen since April. Here is the damage report. Nvidia, 4%. Palantir, 8%. Meta, down more than 5%. AMD, down about 3.7%. And the entire semiconductor sector getting absolutely hammered. But here's what's really important. This wasn't just a random volatility period. This was a specific market event called profit taking after unrealistic valuations. And I need to be brutally honest with you, because your money depends on this. Some of these AI stocks valuations are out of touch with the reality, but that doesn't mean all AI stocks are overvalued. We're going to separate the hype from the reality, and we're going to look at which AI stocks are actually worth owning, which ones are bubble territory, and most importantly, what you should be doing right now with your portfolio. Because I guarantee you there's money to be made in this sell-off if you know where to look. So we're going to go over a lot of things, so make sure you use the timeline in the description if you want to jump ahead. Number one, why did this happen? What caused this 3% Nasdaq drop? The headlines will tell you AI concerns and bubble fears, but the real story is more nuanced, and I'll break it down into 3 specific triggers. Trigger number 1 is the valuation reality check. Look, Nvidia had a 5 trillion market capitalization. That's insane. The entire company is valued at $5 billion. For context, that's more than double the market cap of the entire energy sector combined. It's more than the market cap of all banks in America combined. Now here's the question. Does Nvidia growth justify that valuation? Nvidia trading at about 59 times forward earnings. That's really expensive. That's significantly higher than the S&P 500 average of 21 times. So investors started asking themselves, is this really worth it, or is this just a lot of hype? When investors start questioning valuations, they start selling. And when Nvidia sells, because it's so massive and so loved, it creates contagion. People sell related AI stocks. People sell semiconductors. People sell cloud companies. One company's decline becomes the entire sector's problem. Trigger number 2, the AI profitability questions. Here's the awkward truth that Wall Street doesn't want to talk about. Most AI companies aren't actually profitable yet. They're spending billions on AI infrastructure, but they're not seeing the returns. Companies like Supermicro have already faced sharp declines because investors are realizing that their explosive growth might not be sustainable. Meta and Amazon are pouring tens of billions into AI infrastructure, data centers, chips, everything. But the ROI isn't clear yet. Investors started asking, so companies are spending insane amounts on AI, but where is the actual profit? That question caused selling. Trigger number 3, the macro picture, the big picture. During the week that tech stocks crashed, the treasury market was also moving. The 10-year Treasury yield was rising. Now that matters because higher interest rates make future earnings less valuable to investors. Why would I invest in future earnings if I can get returns now? Tech and AI stocks are especially sensitive to rates because they're growth stocks. Their value depends on future earnings. If rates go up, future earnings are worth less today. So you had this perfect storm. Massive valuations being questioned, profitability not materializing, and interest rates rising. That's why we saw the Nasdaq drop 3%. It wasn't just AI bubble fear. It was actual fundamental concerns meeting macro conditions. And investors rightfully decided to take some chips off the table. Now, the second thing we want to talk about is the data behind the bubble narrative. And here's where we need to be very careful. Yes, I'll give it to you, some AI stocks are overvalued. But is there actually an AI bubble that's about to burst? Or is this just normal market volatility? Let me give you the real data in the bull and the bear case. In the bull case for AI, over the past 2 years, AI-related companies have massively outperformed the broader market. Nvidia, for example, is up something like 50% this year alone. Palantir is up over 107% this year. Broadcom is up significantly. These aren't small moves. These are huge moves, and they're being driven by real business fundamentals. Nvidia's revenue is crushing expectations. Their data center business is growing at triple-digit rates. Amazon and Microsoft are spending on AI infrastructure because they believe in it. That's not hype. That's real capital allocation. Now let's move over to the bear case. Yes, valuations are extended. Yes, some companies are spending on AI and not seeing immediate returns. But here's the real risk. If AI investments don't pay off as fast as people expect, you could see significant corrections in growth stocks. Some analysts are predicting a 10 to 15% drawdowns on AI-related sectors if sentiments shift. Some other ones are saying over 20%. The worst case is some people are predicting potential 40 to 50% decline in certain AI stocks if there is a severe repricing. So here's the truth. We're not in a massive bubble about to crash 80%, but we are in a correction phase where reality is meeting expectations. And this is totally normal. That's actually healthy. And honestly, it's a buying opportunity for smart investors. The valuation reality is Nvidia at 59x forward earnings is actually high, but not unprecedented for a growth company. Broadcom growing AI chip revenue at 53% is real growth. Now, Applied Digital revenue growing 84% year over year is also real, although they're not profitable yet. Meta and Amazon investing tens of billions in infrastructure, and AI infrastructure, that they're not idiots. They know what they're doing. They're not throwing away tens of billions of their money. The question isn't, is AI real? The question is, are specific AI stocks overvalued? And the answer is, some are, but not all. Let's turn to the third point, which AI stocks are actually safe bets. Now let's break these down into 3 tiers. Tier 1 is the established profitability players. These are companies that are already profitable from AI. First is Broadcom, and that's ticker AVGO. It's up 53% on AI chip revenue alone. This company is printing money from AI infrastructure. They are essential. No company can build AI systems without Broadcom chips. This is a safe bet. Next is Nvidia. Yes, it's expensive, but they dominate the AI chip market. No real competition because they've already got the schedule with the production lines for the AI chip sector for the next 4 years at least. Is it going to go higher? Maybe, but the business is real and growing. These companies have earned their valuations through actual revenue and profits. That's different from speculation. Tier 2 is high growth, pre-profit companies. Still safe if you understand the risk. Number 1 is Applied Digital. Revenue growing 84% year over year. No profits yet, but growth is real and demand is insane. Palantir, yes, it got crushed last week, but it's growing government and enterprise sales. The company is actually becoming more profitable. The sell-off was profit-taking, not a fundamental problem. These companies aren't cheap, but the growth is real and they're on a path to profitability. Tier number 3, which is the hype play. This is where you need to be careful and do your own research. First on the list is Supermicrocomputers. This company had explosive growth, but then investors realized it was too concentrated in a few customers. It faced sharp declines. This is the kind of company that could hit harder in a correction or recession. My recommendations is hold your positions in tier 1 companies like Broadcom and Nvidia. Buy the dip on tier 2 companies if you have the conviction, and avoid tier 3 companies if you're not an expert. The point is, not all AI stocks are bubbles. The bubble is in hype, not in the underlying AI revolution. And if you're not sure about what AI I'm talking about, if you're thinking this is the road to AGI, check out the video. I'm going to link it in the top right or top left, where we talk about what is happening with AGI. Now let's talk about what the correction means for your portfolio. This is what you should actually be doing with your money right now. And I'm going to break it into 5 steps. Step 1, don't panic sell. This is a 3 to 5% correction after an enormous rally. This is normal. If you sold everything after last week's dip, you'd be locking in losses, and don't do that. Step number 2, use the weakness to rebalance. If you're 70% growth and 30% defensive, maybe rebalance to 60% growth and 40% defensive. Buy some value stocks, some energy stocks, some dividend pairs. When growth stocks fall, it's a good time to buy defensive stuff that got ignored. And big money, smart money, is already doing that. Step 3, dollar cost average into AI. Don't throw your money into Nvidia at once. But if you believe in the AI long term, which you should, depending on which AI we're talking about, use this weakness to add positions gradually. Buy $1,000 worth of Nvidia, wait a week, buy another 1,000, average down into your winners. Not a financial advice. Step 4, take profits on winners that went too far. If you bought Palantir at $20 and it's $140 right now, maybe take 20-30% off the table. Lock in life-changing gains, rebalance, reduce risks, move them into defensive stocks. Step 5, position for the December Fed cut. Remember, from our previous videos, the Fed's cutting rates in December. That's bullish for growth stocks. So yes, we might see more volatility in the short term, but by January 2026, we could be at an all-new time high. That's when you want to be long. Here's the bottom line. The correction is a feature, not a bug. It's weeding out the hype-driven stocks and rewarding the real winners. Smart investors use this weakness to build positions in the real winners. Look, the AI revolution is real. That's not changing. What's changing is that investors are getting more selective about which AI stocks are worth owning. That's healthy. That's how markets work. If you found this analysis valuable, and I know it was honest and not cheerleading for anybody, like this video, subscribe to the channel so you can stay up to date as we release more videos. This channel is very new and we would love your support. Thanks for watching. Until next time, stay diversified, stay safe, and I'll catch you in the next video.